Question 1. In California, what is the minimum free look period for a new life insurance policy? A. 7 days. B. 10 days. C. 20 days. D. 30 days. Answer: B. 10 days. The free look period, also known as the right to examine period, allows a policy owner to review a new life insurance policy and return it for a full refund of premiums paid if they are not satisfied. In California, the minimum free look period for a new life insurance policy is 10 days from the date of policy delivery. This consumer protection ensures that buyers have adequate time to understand the policy's terms and conditions before fully committing. If the policy is returned within this timeframe, the insurer must refund all premiums, making it a crucial safeguard for consumers. Question 2. A life insurance policy's incontestability clause generally prevents an insurer from voiding a policy due to misrepresentations in the application after it has been in force for a specific period, typically A. 6 months. B. 1 year. C. 2 years. D. 5 years. Answer: C. 2 years. The incontestability clause is a standard provision in life insurance policies designed to protect the policyholder. This clause states that after a policy has been in force for 2 years from its issue date, the insurer cannot void the policy, even if material misrepresentations or concealments were made in the original application. This means that after 2 years, the insurer cannot refuse to pay a death benefit based on inaccuracies in the initial application, providing security to the beneficiary. This protection encourages truthful disclosures during the application process but also limits an insurer's ability to challenge coverage indefinitely. Question 3. Which of the following statements regarding the surrender of a cash value life insurance policy in California is true? A. The policy owner must forfeit all cash value if the policy is surrendered. B. The policy owner is entitled to the policy's cash surrender value, less any outstanding loans or charges. C. Surrendering a policy means the death benefit will be paid out immediately. D. The policy owner must wait until the policy matures to access any cash value. Answer: B. The policy owner is entitled to the policy's cash surrender value, less any outstanding loans or charges. When a cash value life insurance policy is surrendered, it means the policy owner is giving up the policy and its death benefit in exchange for its accumulated cash value. Upon surrender, the insurer will pay the policy owner the accumulated cash surrender value, minus any outstanding policy loans or unpaid premiums. This action terminates the policy, ending all coverage and future premium obligations, providing a way for policy owners to access their accumulated savings if they no longer need the insurance coverage. Remember, surrendering a policy effectively cancels it, so consider the long-term implications before making such a decision. Question 4. What type of life insurance policy is characterized by a death benefit and cash value that fluctuate based on the performance of a separate account, which is invested in stocks, bonds, and other equities? A. Whole life. B. Universal life. C. Variable life. D. Term life. Answer: C. Variable life. Variable life insurance is a type of permanent life insurance where the cash value and death benefit can vary, or be variable, because they are linked to the performance of a separate account. This separate account invests directly in securities like stocks, bonds, and mutual funds, chosen by the policy owner. Due to the investment risk assumed by the policy owner and the security-based nature of the separate account, selling variable life policies requires both a state life insurance license and a FINRA securities registration. Unlike other policies, variable life offers potential for higher returns but also carries investment risk. Question 5. In California, a stranger-originated life insurance (STOLI) arrangement is generally considered A. A legitimate method for charitable giving. B. An acceptable form of estate planning. C. An illegal transaction due to lack of insurable interest. D. A type of group life insurance. Answer, C. An illegal transaction due to lack of insurable interest. Stranger-originated life insurance, STOLI, also known as investor-originated life insurance, IOLI, involves a third party with no insurable interest in the insured initiating and funding a life insurance policy, intending to sell it to investors. In California, such arrangements are generally considered illegal and against public policy because they violate the fundamental principle of insurable interest at the time the policy is issued. Insurable interest means that the policy owner must stand to suffer a financial loss if the insured dies, which is absent in a STOLI arrangement. This prohibition protects against wagering on human lives and potential moral hazard. Question 6. All of the following are typically considered non-forfeiture options in a whole life insurance policy except A. Cash surrender value. B. Extended term option. C. Reduced paid-up option. D. Automatic premium loan. Answer, D. Automatic premium loan. Non-forfeiture options are choices available to a policy owner when a cash value life insurance policy is surrendered or lapses due to non-payment of premiums. The three standard non-forfeiture options are cash surrender value, taking the cash, extended term option, using cash value to buy a new term policy for the same face amount, and reduced paid-up option, using cash value to buy a lower face amount whole life policy. The automatic premium loan is a policy loan provision, not a non-forfeiture option. It uses the cash value to pay an overdue premium to prevent lapse, rather than being an option chosen after lapse or surrender. Question 7. If a policy owner in California takes out a loan against their whole life insurance policy's cash value, which of the following is true regarding the loan? A. The loan must be repaid within a specified period, typically 5 years. B. The loan accrues interest and, if not repaid, will reduce the death benefit. C. The insurer must approve the loan based on the policy owner's credit score. D. The policy's cash value will immediately cease to earn interest. Answer, B. The loan accrues interest and, if not repaid, will reduce the death benefit. Policy loans are a unique feature of cash value life insurance, allowing the policy owner to borrow money using the policy's cash value as collateral. These loans accrue interest, and while there's no mandatory repayment schedule, any outstanding loan amount plus accrued interest will be subtracted from the death benefit paid to the beneficiary if the insured dies before the loan is repaid. This access to cash value can be a valuable financial resource, but it's important to remember that it impacts the ultimate payout to beneficiaries. Question 8. The period during which an annuity's contributions accumulate interest and grow on a tax-deferred basis, before the annuity payments begin, is known as the A. Annuitization phase. B. Payout phase. C. Accumulation phase. D. Distribution phase. Answer, C. Accumulation phase. Annuities have two main phases, the accumulation phase and the annuitization, or payout, phase. The accumulation phase is the period during which the annuity owner makes payments into the annuity, and the funds grow tax-deferred based on the annuity's terms, example fixed interest, variable performance. During this time, the owner can typically surrender the annuity for its cash value, though surrender charges may apply. The annuitization phase begins when the accumulated funds are converted into a series of regular payments to the annuitant, providing a steady income stream. Question 9. An employee covered under a group life insurance policy in California who terminates employment typically has the right to convert their group coverage to an individual policy without evidence of insurability within how many days? A. 15 days. B. 31 days. C. 45 days. D. 60 days. Answer, B. 31 days. A key feature of group life insurance is the conversion privilege, which allows an individual whose group coverage terminates, example due to job loss, to convert their group policy to an individual life insurance policy. In California, this conversion must be offered without requiring evidence of insurability, meaning no medical exam, provided the employee applies for the individual policy within 31 days of their group coverage termination. This ensures continued coverage for individuals regardless of their health status, albeit typically at a higher premium rate for the individual policy. Question 10. In California, the head of the Department of Insurance, CDI, is known as the A. Director of Insurance, B. Superintendent of Insurance, C. Commissioner of Insurance, D. Secretary of Insurance. Answer: C. Commissioner of Insurance. The California Department of Insurance, CDI, is responsible for regulating the insurance industry in the state and protecting consumers. The chief officer overseeing the CDI is the Commissioner of Insurance, who is an elected official. The Commissioner's duties include enforcing insurance laws, issuing licenses, regulating rates, and investigating consumer complaints to ensure fair and competitive insurance markets. Understanding the Commissioner's role is crucial as they are the primary authority for all insurance-related matters in California. Question 11. Under California law, if an insurer requires an applicant to take an HIV test for life insurance underwriting purposes, which of the following is false? A. The insurer must obtain the applicant's written consent. B. The test results must be kept confidential. C. The insurer must offer counseling services related to the test. D. A positive test result automatically disqualifies the applicant from coverage. Answer: D. A positive test result automatically disqualifies the applicant from coverage. California law imposes strict regulations on HIV testing for insurance purposes, prioritizing applicant rights and confidentiality. While an insurer can require an HIV test with written consent and must keep results confidential, a positive result does not automatically disqualify an applicant from coverage. Insurers must evaluate each case individually based on underwriting guidelines, and they cannot discriminate solely based on HIV status. Additionally, counseling services related to the test results must be offered, emphasizing support and privacy. Question 12. If a life insurance applicant in California intentionally misstates their age on an application, and this misstatement is discovered after the policy is issued, what is the most likely outcome? A. The policy will be immediately voided, and premiums will be refunded. B. The death benefit will be adjusted to the amount the premiums would have purchased at the correct age. C. The insurer will charge additional premiums to cover the difference. D. The policy will remain unchanged, as age misstatement is not material. Answer: B. The death benefit will be adjusted to the amount the premiums would have purchased at the correct age. The misstatement of age or sex provision is a standard clause in life insurance policies. If an applicant's age or sex is found to be incorrect, the insurer will typically not void the policy. Instead, the policy's death benefit will be adjusted to reflect the amount that the premiums paid would have purchased at the insured's correct age or sex. For example, if someone understated their age, they would have been paying too little, so the death benefit would be reduced proportionally. This provision ensures that the correct amount of coverage is provided for the premium paid, maintaining fairness without canceling the policy. Question 13. The waiver of premium rider in a life insurance policy typically provides that A. Future premiums are waived if the policy owner becomes unemployed. B. Future premiums are waived if the insured becomes totally and permanently disabled. C. The policy's cash value is used to pay future premiums. D. Premiums are waived after a certain number of years of policy ownership. Answer: B. Future premiums are waived if the insured becomes totally and permanently disabled. The waiver of premium rider is a valuable optional addition to a life insurance policy, designed to protect the policy if the insured becomes unable to pay premiums due to disability. This rider specifies that if the insured becomes totally and permanently disabled, as defined by the policy, often after a waiting period, the insurer will waive all future premiums for the duration of the disability. This ensures the policy remains in force and its benefits are preserved even when the insured's income is impacted, providing crucial financial security during a challenging time. Question 14. In most cases, the death benefit paid to a beneficiary from a life insurance policy is A. Subject to income tax. B. Subject to estate tax. C. Received income tax-free by the beneficiary. D. Considered a taxable dividend. Answer: C. Received income tax-free by the beneficiary. One of the most significant tax advantages of life insurance is that the death benefit, when paid to a named beneficiary, is generally received income tax-free. This means the beneficiary does not have to report the lump sum payment as taxable income. While the death benefit might be included in the deceased's gross estate for estate tax purposes if the insured owned the policy, it is distinct from income tax. This tax-free payout makes life insurance an extremely effective tool for providing financial security to loved ones. Question 15. When an agent recommends that a client replace an existing life insurance policy with a new one, California regulations require the agent to A. Obtain a signed waiver from the client acknowledging the replacement. B. Advise the client that replacement is always in their best interest. C. Submit a notice regarding replacement to the existing insurer and the replacing insurer. D. Ensure the new policy has a lower premium, regardless of benefits. Answer: C. Submit a notice regarding replacement to the existing insurer and the replacing insurer. Policy replacement, which is the act of lapsing, surrendering, or converting an existing life insurance policy to purchase a new one, is highly regulated in California to protect consumers. When an agent recommends a replacement, they are legally required to provide the client with a notice regarding replacement and submit copies to both the existing insurer and the replacing insurer. This ensures transparency and allows the existing insurer to inform the policy owner about potential disadvantages of replacement, such as new contestability periods, higher premiums due to age, or loss of existing policy benefits. Question 16. In California, for life insurance purposes, a domestic partner is generally treated the same as a spouse with regard to insurable interest if A. They have been living together for at least 5 years. B. They are registered with the California Secretary of State as domestic partners. C. They have a joint bank account. D. They have signed a notarized agreement of mutual support. Answer: B. They are registered with the California Secretary of State as domestic partners. California law recognizes registered domestic partnerships and grants them many of the same rights, responsibilities, and protections as marriage, including for insurance purposes. For a domestic partner to have an automatic insurable interest in the life of their partner, allowing them to purchase life insurance, they must be registered with the California Secretary of State. This legal recognition ensures that partners in registered relationships can secure life insurance for each other, reflecting the state's progressive stance on partnership rights. Question 17. Which dividend option allows the policy owner to use policy dividends to purchase small, single premium policies that add to the face amount of the original policy? A. Cash option. B. Reduction of premium option. C. Paid-up additions option. D. 1-year term option. Answer: C. Paid-up additions option. Life insurance policy dividends, which are a return of unneeded premium, are not guaranteed, but if paid, policy owners have several options for how to receive them. The paid-up additions option uses the dividend to purchase small, fully paid-up whole life policies that are added to the original policy's face amount. These additions also build cash value and earn dividends themselves, effectively increasing the policy's death benefit and cash value over time without requiring additional premiums. This option offers a way to grow the policy's value. Question 18. The suicide clause in a life insurance policy typically states that if the insured commits suicide within a specific period from the policy's issue date, the insurer will A. Pay the full death benefit. B. Pay a reduced death benefit. C. Refund the premiums paid. D. Pay nothing. Answer: C. Refund the premiums paid. The suicide clause is a common provision in life insurance policies designed to prevent individuals from purchasing a policy with the immediate intent of suicide. This clause usually states that if the insured commits suicide within 2 years of the policy's issue date, the insurer's liability is limited to a refund of the premiums paid, rather than paying the full death benefit. After this 2-year period, the suicide clause typically no longer applies, and the full death benefit would be paid. This clause is a crucial anti-fraud measure. Question 19. If a life insurance policy owner names their spouse as the irrevocable beneficiary, which of the following is true? A. The policy owner can change the beneficiary designation at any time without the spouse's consent. B. The policy owner needs the spouse's written consent to change the beneficiary, borrow against the cash value, or assign the policy. C. The spouse automatically forfeits their beneficiary rights if they divorce the policy owner. D. The policy owner cannot borrow against the cash value under any circumstances. Answer: B. The policy owner needs the spouse's written consent to change the beneficiary, borrow against the cash value, or assign the policy. An irrevocable beneficiary designation means that the beneficiary has a vested interest in the policy's benefits, and the policy owner cannot make any significant changes to the policy without that beneficiary's written consent. This includes changing the beneficiary, taking out policy loans, or assigning the policy. This designation provides a much higher level of security for the beneficiary compared to a revocable designation, where the policy owner can change the beneficiary at any time without consent. Choosing an irrevocable beneficiary should be carefully considered, as it significantly limits the policy owner's control. Question 20. Which of the following accurately describes a key difference between whole life and universal life insurance policies in California? A. Whole life policies offer flexible premiums and death benefits, while universal life policies have fixed premiums and death benefits. B. Universal life policies offer flexible premiums and death benefits, while whole life policies have fixed premiums and guaranteed cash value growth. C. Only whole life policies accumulate cash value. D. Only universal life policies require evidence of insurability. Answer: B. Universal life policies offer flexible premiums and death benefits, while whole life policies have fixed premiums and guaranteed cash value growth. The primary distinction between whole life and universal life insurance lies in their flexibility. Whole life policies are characterized by fixed, level premiums, a guaranteed death benefit, and cash value that grows at a guaranteed rate. In contrast, universal life policies offer significant flexibility, allowing policy owners to adjust their premium payments, within limits, and death benefit amount to meet changing needs. While both build cash value, universal life's growth is often tied to current interest rates, making it more sensitive to market fluctuations compared to the guaranteed growth of whole life. Question 21. A viatical settlement involves a policy owner selling their life insurance policy to a third party for less than its face value, typically because the policy owner is A. Seeking to retire early and supplement income. B. Terminally or chronically ill and needs immediate access to funds. C. Looking to exchange it for an annuity. D. Trying to avoid estate taxes. Answer: B. Terminally or chronically ill and needs immediate access to funds. A viatical settlement is an arrangement where a terminally or chronically ill policy owner sells their life insurance policy to a third party, a viatical settlement provider, for a lump sum cash payment that is less than the policy's face value but more than its cash surrender value. This option provides immediate liquidity to individuals facing severe health challenges and substantial medical expenses. It's a way for someone with a shortened life expectancy to access a portion of their life insurance benefit while they are still alive. Question 22. What is the primary purpose of the Medical Information Bureau, MIB, in the life insurance underwriting process? A. To conduct medical exams for applicants. B. To collect and share medical and personal information about applicants among member insurers to detect fraud. C. To provide medical advice to underwriters. D. To approve or deny insurance applications based on medical records. Answer: B. To collect and share medical and personal information about applicants among member insurers to detect fraud. The Medical Information Bureau, MIB, is a non-profit trade organization that collects and stores coded information about health impairments of individuals who have applied for insurance with its member companies. Its primary purpose is to help underwriters detect and prevent fraud and material misrepresentation by applicants. When an applicant applies for insurance, the insurer checks the MIB database to see if the applicant has previously reported any medical conditions to other member insurers, ensuring consistency in application information. It acts as a warning system for insurers, not a database of medical records or a decision maker. Question 23. The human life value approach to determining the amount of life insurance needed is based on calculating the A. Present value of the insured's future earnings. B. Total debts and liabilities of the insured. C. Cost of replacing the insured's assets. D. Insured's projected retirement savings. Answer: A. Present value of the insured's future earnings. The human life value approach is a method used to estimate the amount of life insurance an individual needs. It calculates the financial loss that would be incurred by their dependents if the insured were to die prematurely. This is done by determining the present value of the insured's future earnings that would have been contributed to the family, accounting for factors like the insured's age, occupation, and expected retirement age. This approach focuses on replacing the economic contribution of the insured, providing a concrete way to quantify the financial impact of their loss. Question 24. Which of the following is considered an unfair trade practice in the sale of life insurance in California? A. Explaining the benefits of a specific policy. B. Twisting, which involves inducing a policy owner to lapse an existing policy to purchase a new one to the client's detriment. C. Providing a policy illustration showing guaranteed values. D. Offering a free gift of nominal value, example pen, calendar, for attending a sales presentation. Answer: B. Twisting, which involves inducing a policy owner to lapse an existing policy to purchase a new one to the client's detriment. Twisting is a specific type of unfair trade practice in insurance, illegal in California, where an agent or insurer makes a misleading comparison of policies to induce a policy owner to surrender, lapse, or forfeit an existing policy to purchase a new one, primarily to the policy owner's detriment. This practice is prohibited because it often results in the client losing valuable benefits, facing new surrender charges, or starting new contestability periods without a clear benefit, prioritizing the agent's commission over the client's best interest. Agents must always act in the client's best interest and provide accurate comparisons. Question 25. For an individual to sell variable life insurance policies in California, they must possess: A. Only a California life-only agent license. B. A California life-only agent license and a Series 6 or Series 7 FINRA registration. C. A California life-only agent license and a property and casualty license. D. Only a Series 6 or Series 7 FINRA registration, as state licensing is not required. Answer: B. A California life-only agent license and a Series 6 or Series 7 FINRA registration. Variable life insurance policies are unique because their cash value and death benefit are tied to the performance of underlying investment options, such as mutual funds. Because these products are considered both insurance and securities, individuals selling them in California must hold both a valid California life-only agent license, issued by the California Department of Insurance, CDI, and a securities registration, typically a Series 6, investment company and variable contracts products representative, or Series 7, general securities representative, from FINRA, Financial Industry Regulatory Authority. This dual licensing ensures that agents are knowledgeable about both insurance and securities regulations.